Okay, we are live streaming now. So, hello everybody. Welcome to the 9th webinar in this series. Today, the topic is what banking sector needs today, part 2, and we have an amazing set of speakers. Today on chair we have Thomas Franco, and everybody knows Comrade Franco, who has been the force behind this entire webinar series. He's the joint convener of People First and former General Secretary of AIBOC. Today in the speakers, we have Dr. C.P. Chandrasekher, who definitely needs no introduction. He's a famous economist, and I welcome you, sir. I also welcome Dr. Ashok Dhawale, who is from the All India Kisan Sabha and has been a very prominent voice in the farmers' movement. I also welcome Dr. Deepa, who is with the Democratic Youth Federation of India. She has also been a very prominent voice in terms of what youth need today. So I welcome everybody else who has joined the meeting today. And with this, I give it over to Comrade Franco to begin the meeting.
A very good evening to all of you. This is the 9th webinar we are holding on the occasion of Nationalization Week. Nationalization happened on 19 July 1969, and we have had a number of scholars, economists, trade unionists, youth, speaking on this occasion on what is to be done. And this is the final seminar on this series. Here, and in this webinar, which is being done in two parts. The first part was held 4 days back, where Professor Dinesh Abral, Dr. Arun Kumar, Professor Archana Prasad, they spoke on different aspects of what is needed on banking sector today and for future. And today we have Dr. C.P. Chandrasekher, who was a member of the Independent Commission on Banking when the neoliberal economic policy was started, and Mr. T.R. Bhatt is here, who was coordinating with the team to bring out that publication. And Dr. Chandrasekher has been writing on banking and economy regularly. He writes to Frontline. He also writes to Business Line. He had been teaching in the Jawaharlal Nehru University till now, and he is a visiting faculty to various universities across the world. And he along with Professor Jayadi Ghosh, brought out a book in 2018 on what is to be done for the banking sector. So he had been telling what is to be done. Only thing, this government had not been following his advices. Otherwise, we would not have got into this mess. So in this webinar, we will be discussing various aspects from various viewpoints, different viewpoints. As I said, Professor Archana Prasad, that they spoke about the women point of view, how women are not getting adequate credit, how microfinance institutions have taken over the self-help groups, like that. And today we have Dr. Ashok Dhawale, who will be speaking on what the farmers exactly need at this point of time, as well as for the future of the economy of this country, how the farmers' needs have to be addressed. And we have a young, vibrant Dr. Deepa. She is with the DOFI, Democratic Youth Federation of India. She completed her doctorate from Madras Institute of Development Studies recently. She has spoken in some of our webinars earlier also when we had this reimagining the future, she was a speaker. She will be speaking at the point of view of a student as well as youth. What the student community needs today and what the youth of the country needs today from the banking sector. But first we will hear from Dr. C.P. Chandrasekher, who will be giving an overview of what is needed for this country. Country as a whole, what has to be done in the banking sector so that we really cater to the largest section of the society and banking sector fulfills the goal of nationalization. So with this brief introduction, I request Professor C.P. Chandrasekher to make his presentation. There are only three speakers. Asha Mishra is not able to join today because of some emergency. So each speaker will have 25 minutes to speak. And followed by that, there will be a question answer. The question answer will be only in through the chat box. So you can start raising your questions in the chat box, and whichever questions are relevant, we will request the respective speakers to respond to that questions. So with this, I hand over to Professor C.P. Chandrasekher to speak on what the country needs in the banking sector today. Thank you. Thank you, Professor.
Thank you, Comrade Franco, and thanks to CFA and the others for having invited me to participate in today's discussion. The topic, as all of you know, is a large topic on what needs to be done to banking in India, given the fact that we've had 30 years in which much damage has been inflicted, the economy in general, but the banking sector in particular. Obviously, that is an extremely tough question to deal with for any of us. However, what I want to do is I want to start from this conjuncture of this discussion occurring and partly being held in the context of the completion of 3 decades since the launch of what would be full-fledged and accelerated neoliberal reform in India. And we know that quite early into that process, financial reform in general and banking reform in particular, we made central elements of the neoliberal agenda. We had, starting right at the beginning in the early 1990s itself, the first Narasimhan Committee report, to be followed by the middle of the 1990s to the second one. The first was on overall financial reform with reference to banking, of course, and then, of course, the second was more focused on the question of the banking sector. Now, the fundamental thrust of those reports, in my reading, was that it was an attack on the notion of the use of banking or the banking system as an instrument for broad-based and let's say more egalitarian development, which was what nationalization was all about. The whole idea was to take control of the savings which accumulate or get deposited in the banking system, away from the corporate sector, which had resulted in a large part of those savings being diverted to the interests of a few big corporates, who were also part of business groups, as were many of the banks. And the whole idea was that had resulted in a situation where the allocation of credit or the use of the nation's savings was such that it accentuated the inequalities which resulted from the basic inequality of asset distribution which existed in India in independence, and which to a certain extent, not to a certain extent, to a substantial extent, even the earlier regimes under Nehru and subsequently did not manage to confront. And it was becoming clear that superimposed upon this underlying asset inequality, which of course generates in turn income inequality, was a banking system whose functioning had resulted in a situation where development was not only not broad-based, with, as all of you all know, at that point of time, something like 2% of total credit being diverted to the agricultural sector, out of the scheduled commercial banking credit being diverted to the agricultural sector. And of course, that it's the use of the savings was tending to accentuate the inequality which came from the base inequality which characterized India's capitalist path. Now, in that reading, obviously, of the tendencies and inequality, which was investigated not just by critiques of the regime, but a large number of official committees. So we had the Monopolies Inquiry Commission report, we had the Dutt Committee report, the Industrial Licensing Policy Inquiry Committee report, we had the Mahalanobis Committee report on distribution of income and levels of living. And all of them, while trying to look into the causes which was resulting in the accentuation of inequality, which had by the mid-60s become a major issue in the country, saw banking or the control of banking by the corporate sector as being a factor which contributed to the accentuation of that inequality. And in some sense, the effort to recapture control over savings was meant to convert banking into a development instrumentality in order to be able to further the development agenda in a form or in a way in which it was not as inequalizing as it was tending to be in the period prior to 1969. And this obviously meant many things. It meant changing the frame of banking. It meant changing the banking behavior or the behavior of managers and officers in the banking system. It meant, to a certain extent, changing priorities, where to that you actually downplayed the importance of profit as a metric in analyzing the success of banking, but rather looked to other indicators, the credit deposit ratio by districts and state levels, the reach of the banking sector, not merely in terms of proportion of branches per, let's say, 100 of the population, but also in terms of the degree to which it moved to the underbanked segments of the economy, the rural areas in general, and particular states, particularly in north of India, etc. So the whole idea was that you needed to actually change the metrics by which you judged the success of banking, because now banking was not to be seen as a mere financial activity geared to profit as capitalist institutions tend to be, but the idea was to use these metrics to actually judge the success of banking. Now, the Narasimhan Committee reports were quite clear that the use of banking in this form was actually detrimental to the promotion of growth, because it actually preempted savings and used it for purposes in which there was directed credit being allocated to segments which were not contributing adequately thought to growth and were actually weakening the banking system. And it pointed to, factors like profitability, ostensibly something, opaquely called customer service and so on and so forth, to actually attack the banking system. But the attack was not just on the public banking system. The attack was on the use of the banking system as an instrumentality to promote growth, which is broad-based and more egalitarian, and to do it in a way, given the risks involved in banking activity, to do it in a way in which there is a significant degree of stability in the banking system. And I'm not going to go into those details. What we had observed over those years, let's say from 1969 right up to the end of the 1980s, was amazing success in terms of the achievements as recorded through the use of evidence which was linked to the motivations which underlay the nationalization process. This set of motivations which I have referred to. Now, this attack obviously meant that this was also an attack on public banking, that it basically said it's because the state took ownership through nationalization that it could, within inverted commas, misuse the banking system for purposes which it argued was undermining its efficiency, as reflected in the profitability indicator, and of course also resulting in the preemption of savings and its allocations in directions which were not to the highest yielding projects, promote growth. That was the kind of understanding which underlay the National Committee report. Now, what has happened since, that is, since 1991, was that we've had a peculiar situation where, while there has been, from the point of view of those who advocated neoliberal reform, of liberalization, of financial liberalization in particular, and banking policy liberalization, was that while there has been some degree of success in transforming the nature of banking in terms of what it seeks to do, in terms of the kind of sectors it engages with, in terms of the principles it uses to allocate credit, in terms of the indicators or the metrics it uses to assess its achievement and success, while that has to a certain extent been modified in keeping with neoliberal ideology, the fundamental aim, which was to undermine public ownership, to denationalize the banking sector and restore corporate control over the nation's savings, that has thus far not been achieved. So it is, even from the point of view of the neoliberals, that we're really talking about a situation where we have a sort of mixed response and a mixed success, that you've gone part of the way in a certain area, but you've not been able to achieve what was, in some sense, an underlying and fundamental goal, which was to do away or to denationalize and therefore reduce state control, which is the only way in which banks could be made to serve, let's say, a larger set of public purposes, even if not completely satisfactorily, but definitely not being aligned completely with the interests of the corporate sector. Now, the fact that there was this partial success in terms of changing the enforced change in banking policy, paradoxically came from the fact that the state actually owned the banks, because the thrust for the shift to neoliberalism, the declaration that India was in crisis in 1991, came from the portals of the finance ministry. It was the government which declared that we are in a state of complete crisis, that there is no alternative but to go to the IMF after pledging our gold to the Bank of England. And going to the IMF meant that there is no alternative other than to completely transform the policy regime which we've been functioning under. And in that, of course, the banking policy regime. So in some sense, that neoliberalism was a state project. While we can say that, the fact that you had to go to the IMF and so on influenced the sort of letter of intent and what you did subsequently, that this was something which was voluntarily chosen by an elite and those who governed the country at that point of time. Now, if that is the choice, obviously you're saying that the state is using the banking system as an instrumentality to pursue this neoliberal strategy, which it is trying to own and embrace itself, rather than, as in many other, let's say, some smaller Latin American countries and many African countries, can be seen to be substantially imposed from outside once you get trapped in a balance of payments crisis. Here it was that the elites were actually seceding in some sense from their own nation and embracing this kind of a policy of aligning with international financial capital. Okay. Now, the thing is, the reason why, besides the fact that the state owned neoliberalism, why the public banking system began to be used as a neoliberal instrument was also because of the consequences of neoliberalism. The first consequence of neoliberalism was, of course, the fact that the government decided that it's going to adopt a more lenient taxation regime vis-a-vis the corporate sector, rationalize the indirect tax regime, culminating, of course, in the GST, and that all of these, including tax concessions which have been offered continuously right up to corporate tax concessions right up to September 2019, in the middle of the pre-COVID recession, that this resulted in a situation where the ability of the state to be able to appropriate a part of the surplus required to finance the activities that it needed to finance was undermined. That very soon, the state found itself in a situation where the fiscal crisis, if you want to call it that, meant that if it wanted to sustain even a reasonable level of expenditure to push growth under a neoliberal regime, then it had to have large fiscal deficits on its budget. But since it had also adopted a conservative fiscal strategy as part of neoliberalism, and in 2003 actually legislated to bind its own hands through the Fiscal Responsibility and Budget Management Act, we ended up with a situation where the state began to see that it was not in a position to be able to finance expenditures in adequate measure. And this touched not merely the welfare expenditures, which affected the majority of the population, did not only affected subsidies and so on, but it also affected the ability of the state to undertake expenditures that would support and incentivize the private sector within a neoliberal regime. In particular, it meant that the state was not in a position to be able to allocate adequate resources to build the infrastructure needed to try and facilitate and lubricate, and in fact, to try and in some sense provide new opportunities for the private sector, particularly in the infrastructural sector. The second failure which resulted from or second weakness which resulted from neoliberalism was that, as was embodied in the recommendations of the Nasrman Committee reports, the government decided, unlike in most other countries, Brazil adopted a neoliberal strategy, but the BNDES, which is the main development bank, is still a major player in the Brazilian economy. China, in fact, set up the China Development Bank after it went in for reform. It did not have a development bank before it went in for reform. It had a monolithic banking system with the People's Bank of China virtually doing everything directly and indirectly through its branch institutions. But these were countries which, in a context of neoliberalism, used the development banking in institutions or specialized banking institutions to actually push investment and push growth. Whereas what India did was that, after having built, starting from the IFCI, going through the ICICI, the IDBI, etc., having built a large development financing infrastructure, it decided to undermine that infrastructure by either rendering rendering institutions like the IFCI dormant, or by getting institutions like the IDBI and the ICICI to set up banks and then reverse merging the development financial institutions with the banks, which essentially meant that increasingly these institutions moved away from the development banking role and began to function as typical commercial banking operations, which at that time, not subsequently, not in the 2000s and after, was one in which banks normally did not engage in undertaking significant lumpy lending to large capital-intensive projects, particularly infrastructural projects, which was something like 3% of total in lending to the industrial sector. So therefore, the government was looking, it couldn't invest. It had undermined or diluted and got rid of the development banking institutions. How is it going to take on its role of facilitating private investment, of in some sense incentivizing and sort of propping up profitability in the private sector? And it decided to do this by using a publicly owned banking system to provide substantial credit to large corporates, not just for infrastructure, for a whole set of activities. Look at Videocon now, for example, in which you're trying to sell it for peanuts, and where the group has taken large amounts. Look at Leela group of hotels. So we are not only talking about power generation, power distribution, roads, ports, civil aviation, etc., but in a whole host of areas, the banking system was used as a mechanism to transfer or to engineer a reverse transfer of wealth from the people at large, from the savings of the nation, into the hands of the corporate sector. And it was thought that this would actually set off a process in which growth under neoliberalism will take India onto the world stage. India will become a major exporter, etc., etc. That didn't happen, we know. And what we really had was the accumulation of these large volume of non-performing assets. And if you have the accumulation of large non-performing assets, then actually, unless you clean the balance sheets of the banks, it will be difficult for banks to function because they become reticent to provide credit. But more importantly, from a neoliberal point of view, unless you clean the balance sheets, you can't privatize the banks. Who's going to buy a bank which is stuck with large non-performing assets on its balance sheet? So you had a situation where the government had to think of ways, like the Indonesians did after the Southeast Asian financial crisis, where the government would, in some sense, write off or fund the writing off of bad assets and then privatize large parts of the whole of the banking system. But where does the money for that come from? Well, one place it could have come from was from the budget. But given neoliberal fiscal conservatism, where you've been lenient on taxation, where you don't want to have a large fiscal deficit, it's really difficult for you to fund the large volume of recapitalization, large volumes of capital needed to recapitalize banks, which needed to write off this huge amount of debt. Okay. So therefore, there was an attempt at a sleight of hand. I mean, we know all sorts of things were adopted. We know what the the recapitalization bonds are. I mean, it was just an accounting device. I mean, the government issues bonds which the banks buy because they're supposed to be gilts. The governments use that money to buy equity in the banks. It pays the interest out of its budget, but it says that otherwise on the capital account, its assets and its liabilities, its assets being the bank's equity and its liabilities being the bonds it's issued, match, so there's no effect on the fiscal deficit. And you can you can engage in sleights of hand of this kind up to a point, but beyond that, it's difficult. So doing it through the budget was increasingly proving to be a problem. We had many experiments. We had Indradhanush, et cetera, many rounds of recapitalization. So you really had a problem to do it from the budget. The second, of course, was to try and in some sense, over a period of time, get rid of this through a process of efficiently disposing of bad assets at a reasonable discount so that finally the books would be clean. And part of the way in which you could recapitalize in the interim is to issue equity, that is to privatize, to reduce government holding in the banking system. But we know that the ARCs, the asset reconstruction corporations, and even this new bad bank, I mean, they didn't work. They were actually demanding huge haircuts. After the haircuts, the amount to which banks received cash as opposed to security receipts was low. Those security receipts could not be treated as standard assets. So you really were not overcoming the problem. And here again, there were many attempts at accounting manipulation. The bad bank, which they're talking about now, and this, the one more asset reconstruction corporation is the same thing. The banks put a certain amount of money into the ARC. The ARC uses that to pay a little bit of cash to buy up the hugely discounted debt. And then the banks have security receipts. But all you're saying is that the government is now going to guarantee those security receipts. And if it guarantees that, it could be treated as standard assets. So you can actually say that I'm removing bad assets out of my system without putting in too much money. But beyond the point, the government itself begins to think about what would be the contingent liabilities it's taking onto its budget as a result of guaranteeing these SRs. And therefore, this is also not going to work. So the government is in that trap. It went part of the way, or significant part of the way, in changing the nature of banking, in using banking not as an instrumentality for broad-based development, but using banking as an instrumentality to incentivize the corporate sector. Doing that, it accumulated bad debt. Having accumulated bad debt, it could not get rid of this bad debt because it's fiscally conservative under neoliberalism. It is not in a position, is unwilling to tax the corporate sector to get the resources to be able to do this. And therefore, it ends up with a situation in which it's unable to clean the books of the banks. And if it's unable to clean the books of the banks, it is unsuccessful in its effort to realize the the sort of long-term dream, which was reflected in the Narasimhan Committee reports of finally privatizing or denationalizing the banking sector and restoring control of the corporate sector over the nation's savings. So it's in this context I'd briefly like to say, what does this say in terms of what we need to do to banking? The first, of course, is that we need, and we can discuss the details, but we need to restore the resilience of the public banking system. with the guarantee that it will remain public. So that just as much as there was a declaration in the Narasimhan Committee report that there will be no more nationalization, it said that the government must openly declare that there will be no more nationalization and also promise to denationalize in stages. You now need to say exactly the opposite. You have to say that, listen, we've realized that even the little bit of recapitalization that we've done has diluted denationalization and renationalized the banks to a certain extent. Because if you look at the share of publicly owned equity, which was going down in the public banking system, it's now reversed because of the fact that you've not been able to privatize, but on the other hand, you put in a certain amount of money, not enough, but put in a certain amount of money to be able to engage in these kinds of activities. The second thing which you need to do is not merely to say that, listen, we're going to have, we do still need to clean the books of the banks, because of the fact that if we want to use these banks as an instrumentality of the kind that they will use during the years after nationalization, taking into account, of course, the changed context, then we need banks which are resilient, which are capable of being able to take the social risks needed to undertake these activities. And therefore, we need to clean the books of the banks. How do we clean the books of the banks? First, we need to get away from fiscal conservatism in the short run. We need to restore reasonable taxation, a reasonable debt to GDP ratio, such that we use monies not merely for education and health, but also to start with, also partly to be able to recapitalize banks. And thirdly, we need to get the Reserve Bank of India to change its stance. Some of those assets which sit on the books of banks should be securitized, and the central bank should buy this up by infusing money into the system. If after the 2008 financial crisis, the Federal Reserve could go into the market and buy any piece of paper, however toxic it was, just in order to save its banking system, we can do the same. And if the Reserve Bank of India can every year keep transferring money which nobody knows comes from where, what is the profit of a Reserve Bank of India? It basically is an hedge. It can keep transferring money from its account into the budget. Why not transfer it to actually recapitalize the public banking system and reestablish its resilience? Once the resilience is reestablished, I do think it is necessary to move forward in terms of repurposing the public banking system. And repurposing this resilient banking system would essentially mean that we should once again think of ways in which we can direct credit in directions and in ways which would actually ensure that there is not merely a contribution to driving growth in a supply side led way, though of course supply alone doesn't determine, we need to build demand. And the second thing is to do it in such a way which is broad-based, to do it in ways which would actually reach out credit to sectors in which credit had begun to reach in significant measure under nationalization, but in which there's been a withdrawal. And to do this through actually having a plural public sector-led banking system of commercial banks, of regional, the RRBs, etc., and not through neoliberal and strange institutions like private microfinance institutions. I mean, not just bank SHG linkage, but really private sector-led MFIs or small savings banks or payments banks, which are all ways of trying to provide the corporate sector entry into the banking sphere at a point of time when you couldn't clean the books of the public banks and hand them over on a platter to the corporate sector. You tried to create these new, ostensibly innovative institutions, none of that, but really get back to a situation where you have a hierarchy of institutions, cooperatives, RRBs, commercial and publicly owned commercial banks, and restore, not in the half-hearted way in which the current budget, the most recent budget said it's going to do, restore specialized development banking to actually undertake, supported by a liquidity finance window from the central bank, supported by state guarantees of bonds issued by these institutions, to actually revive the development banking infrastructure such that banks do not have to overexpose themselves too much into into areas which involve liquidity mismatches as well as maturity mismatches by taking short-term capital from depositors and overcrowding investments into long-term, long maturity, lumpy and illiquid investments in the infrastructural sector. So in some sense, we need a contemporary version of what was sought to be done in terms of using public banks as an instrumentality in the period after 1969. Now, if we do construct a 21st century version of what would be a more broad-based and egalitarian financial system with with the dominance of public banking, that itself might not be might not take us all the way. Finally, the part of the reason why nationalization and all of nationalized banking became vulnerable was because of the fact that there was a system failure, that the real economy was doing pretty badly. And when it did well in the 1980s, it essentially did it on the basis of large-scale borrowing in the form of huge deficit-based borrowing, including deficit financing to finance current expenditures as opposed to capital expenditures. So we need to move to a situation in which there is a larger agenda, that we need to embed the transformation of banking in a larger agenda of changing the development trajectory itself, of having wage-led and lower income group-led, demand-led growth, of having a situation in which we revive agriculture, restore the viability of crop production, of creating a situation in which we address asset inequality so that we don't have gross income inequalities which undermine the needed growth in demand, etc. Unless we have that, then what we would find very soon is that once again, a reconstructed public banking system would confront constraints which the real economy set, and in some sense, deeply determine what banking can do. Finally, the so-called extremely successful Japanese banking sector failed when, after the 1980s, industrial growth in Japan got undermined because of basically of the Plaza Accord, the appreciation of the yen, enforced appreciation of the yen because of American influence, etc. But we need to actually create a situation where the real economy is in a position to be able to provide the foundation on which we can use this instrumentality to pursue a more broad-based and egalitarian growth strategy. I think I'll stop here. Franco, I have finished.
Thank you very much, Dr. Chandrasekher. It is a real overview of what has happened and what has to be done. You have stressed on the need for development banking, the reverse transfer of wealth which is taking place after the neoliberal policies have been implemented, and the capitalization which is given to the banks, it is more for write-off, because all the banks are making gross profit, only the net profit is down because of the write-off, and this write-off goes to the corporates. And the banks are being used to incentivize the corporates, you have said. And we have also said that what is needed is restoring the resilience in the public banks and to make the public sector banks remain as public. They should cater more to the public than to the corporates. And you also stated that we need the banks to take the social risk, which is now absent even in the case of public sector banks to some extent. Public sector banks are now putting on their deposits in investments than to give credit. You have also stated that they restore the tax regime, that is taxing the rich, improve the CD ratio, which is going down now because of the investment, and once again, the states which are not doing well, they are getting a poor credit. And you also highlighted that the RBI has to change, and you also question from where the RBI is actually making the profit and transferring to the government periodically. The system failure in the economy is the root cause you have highlighted. The income inequality is increasing. This is one major aspect which many people don't look at. After the nationalization, the income inequality came down, and after 1991, once again, the income inequality is increasing dramatically. To reconstruct the economy, the banking is needed, you have very clearly stated. And there is one particular question to you from CJ Nandakumar, the President of the Bank Employees Federation of India. The question is, to get out of the crisis of pledging our gold in Bank of England, we embraced neoliberalism, which led us to another crisis, which now warrant us to sell our family silver. Is this the merit of economic reforms that Dr. Manmohan Singh recently claimed, and worried about the daunting road ahead? So I would like to add to this that some of the Congress people nowadays keep saying, I have addressed some meetings in which Congress leaders had openly said that we regret for what we did during the neoliberal economic policy regime. Even Rahul has stated that yes, we have committed mistakes, we have to rectify. But Dr. Manmohan Singh, similarly, Mandak Singh, Ahluwalia, like people, they still are claiming that whatever they did is correct. So in that, we want your reply to that.
Should I do that now?
Yes, because you have to leave in between, so I put up the question now itself.
Well, to start with the first question, I do think, and not I, at that point of time, at the point of time of the 1991 crisis, there were many people who wrote about, Professor Gulati, Professor Prabhat Patnaik, Ashok Mitra. Many people said that there were other options, that, this is not a crisis, because after all, as I said, the crisis was declared by the finance ministry. It was not that all sorts of, that the government was denying that there was a crisis and other people were saying, the IMF or whatever it is was saying there was a crisis. The crisis was declared by the finance ministry. And of course, at that time, the finance minister was Dr. Manmohan Singh, and one of his closest advisors, and he remained so subsequently as well, was Montek. So the thing was, at that point, there were alternatives which was available. It said that, listen, we can borrow even first of all, there were other areas from which we could borrow. We can even borrow from the IMF in tranches which were small, so that we were not subject to the kind of extreme conditionality that comes with large-scale EFF, extended funding facility financing. So, you can be within what your quota permits, and you don't have to accept conditionality. So you don't have to make these kinds of regime transformations. And it basically, they basically said that there were also other areas from which, that is, you could go to, there was still a possibility of India to go to markets and obtain foreign exchange. So this whole idea that there was no option other than to go to the IMF, and if you go to the IMF, you have to do this, was a complete, it was actually an argument which was being used by sections which wanted to advance the economic reforms. That in fact, there used to be rumors in the sort of social or cocktail circuits of Delhi. There was talk that we need a crisis, because unless we have a crisis in this country, we really cannot bring about economic reform. This used to be the talk and the gossip which went on for perhaps a few years prior to 1991. So I would not say that it was because of the crisis of pledging our gold in the Bank of England that we went in for neoliberalism. We wanted to go in for neoliberalism, so we chose the route of not doing other things, having to temporarily pledge our gold, and in fact export our gold there because they wanted it in their walls, and then go to the IMF. The other thing is, of course, is the question of why now still do Manmohan Singh and others actually still defend the neoliberal agenda? I do think I do think in some sense in some sense, I mean, it's I suppose I shouldn't assert this like this, but I do think that the fact that we are stuck with a government or two governments, two consecutive governments, which has meant a lot, not just for economic policy, but also for democracy, etc., in this country, was because of the transition to neoliberalism, because of what neoliberalism did. So I do think that it's necessary for us to realize that, I mean, the Congress is ideologically a sponge. It accommodates too much, and when you have a sponge of that kind, which is not able to take the hard decisions or is unable to win the social sanction, it had the social sanction after all in the years of the 1950s and early 60s, but does not use the social sanction when it has it to make or the moves to redress asset inequality. And at that point of time, things, of course, now are different because agriculture has changed considerably in India. But at that point of time, to undermine land monopoly and implement land reforms, etc., that if you're not able to do that, then obviously you are giving way to forces which are able to use the Congress as a means to transform um, uh, economic policy in the direction of a policy which is more suited to the interests of the corporate sector, of international finance, etc. We do know. I mean, listen. I mean, when the crisis came in the mid 1960s. Neoliberalism came at most in the second half of the 1980s under Rajiv Gandhi. But we do know that after the mid 1960s crisis, the Congress did still try and address inequality. I mean, it had the MRTP Act, it had FERA 1973, it had bank nationalization 1969, but it couldn't go in the direction of being able to do enough to transform the strategy of growth of the real economy. And obviously the section which use that failure will never say that, listen, what we did was wrong in terms of neoliberalism. They'll only say, what we did was it is only those who now need to actually fight and win elections are thinking about the fact that whether they should completely back a strategy which has lost its legitimacy, not merely in India but in many parts of the developing and even the developed world. So I think that's the conflict, and we will see it, and so long as there isn't a change in the ideological position, uh, unless it transforms itself into even a truly social democratic party, you're not going to be you're going to be seeing people who defend neoliberalism in substantial measure within the Congress.
There is one more question that is from Mr. T.R. Bhatt. How rational is the concept of Basel norm-based capital adequacy to Indian context in view of a majority of the banks owned by the government? And second, our banks do not have sizable global presence.
It's first let's if you look at the Basel norms itself, what is Basel norms? Basel norms were once you in the United States and then subsequently in the UK, in the Anglo-Saxon financial world, they began undermining, particularly in the United States, undermining the regulatory frame which was put in place after the banking crisis of the 1930s through the Glass-Steagall Act, the McFadden-Pepper Act, etc. I mean, America had one of the most stringently regulated banking systems till the 1970s. It's only in the 1970s that we saw the dismantling of Glass-Steagall, and finally the legal dismantling of Glass-Steagall was in 1999 with the Banking Services Modernization Act. What it was during this period when you were dismantling structural regulation that you wanted some form of market mediated regulation. And what you did is you took lessons from the non-bank financial sector. How did the non-bank financial sector try and regulate itself? It basically said that, listen, you have to have ways in which you keep for yourself a certain amount of capital, and you have, metrics, algorithms, etc., which prevent you from, overstepping the limits to which you should expose yourself to risk. And that's what the Basel norms are. A bunch of central bankers sitting in Basel decided that what we should do is take this lesson. And so what we should say is that we have to have a certain amount of capital which is available to be able to deal with situations of crisis, so that we don't completely desert deposit holders and end up insolvent. But we need to do, and the amount we need to hold has to be measured in terms of the structure of our risk. So the whole thing is the risk weights. What kind of risk weights do you use? Who decides the risk weights? Initially the central bank, subsequently you use the rating agencies to determine the risk weights. Subsequently it became a completely internal process of the bigger banks. But the whole idea is, as you move towards higher risk assets, the amount of capital which you will have to set aside in forms which are costly, to the amount of capital, with costly capital which you will hold, which is unencumbered and is not sort of compromised in terms of being liable, that has to increase, which means that you're undermining your ability to be able to use capital for more risky but a higher return ventures. So you're basically saying that as managers move in the direction of more risky assets, they'll suddenly find that, listen, this is too expensive, because we have to hold this base capital, which is expensive, to compensate for moving towards risk. So the system will automatically push you back. Now, that depends upon, one, how you determine your risk weights. Two, it depends upon who's going to determine how much capital is enough. Is 8% enough? Is 9% enough? Is 10% enough? When the crisis occurred, even 13% wasn't enough. So basically, fundamentally, capital adequacy is a flawed system of market mediated regulation. On top of that, if you have a sovereign guarantee, which is what public bank ownership involves, why do you need to adopt all this? You basically say, listen, I control the central bank, I control the banking system. If anything happens to my banking system, I'm going to make the lender of the last resort also the owner of the last resort. I will get the Reserve Bank of India to print its money and render these banks solvent if at all I push them into a situation where just my sovereign guarantee is not enough for their solvency. So yeah, I definitely don't think Basel is the best way. That's part of neoliberalism.
Thank you very much, sir. Professor Chandrasekher has another meeting.
Well, I'm here for a little more time, yeah.
Yeah, as long as you can stay, I will be very happy. Now we will listen to Dr. Ashok Dhawale, President of the All India Kisan Sabha, part of the Samyukta Kisan Morcha, which is leading the farmers' agitation for more than 8 months. Still no solution is visible. And farmers have been putting up various demands. Earlier also, in some occasions, they have demanded write-off, which was rightfully due to them. And the economy has been for long in crisis. And now, as a banker, I know that practically fresh credit is not reaching the farmers. The farmers are getting the Kisan credit card renewed with additional interest. No fresh cash is made available to them in most of the cases. Every year, the finance minister says you increase the credit by 10%. So 10% is also the average interest rate. So if a farmer has taken 1 lakh loan, This loan is, the KCC is renewed with 1,10,000 limit, and the 10,000 goes to the bank for the interest portion. Practically, the farmer does not get anything in hand to do the agriculture operations. And today we are also seeing that the small credits are diminishing and the large credits are increasing. Earlier in a webinar in this series, we had been listening to Professor Ramakumar, who mentioned that most of the large credits for agriculture are taking place in the cities of the country where there is absolutely no agriculture. So Dr. Ashok Dhawale has been in the field of agriculture for long. He had been with cooperatives, agriculture. He had been with the farmers movement for very long. The long march to the Mumbai was led by the farmers group along with him. And when they reached Mumbai, the government had to come down and request them that please go back, we will fulfill all your demands. So that way, farmers' agitation is a deciding factor, and I am also hoping that the present farmers' agitation also will be a deciding factor, and it will determine the future course of the politics of the country itself. So I request Dr. Ashok Dhawale to please speak for 25 minutes and say what the farmers need today and for the future in this country. Thank you, comrade. Please, over to you.
Good evening, everybody. First of all, I would like to congratulate Comrade Thomas Franco and his team for this very excellent series of webinars, which are connected with the Bank Nationalization Week, which began on the 19th of July. We have heard a very enlightening presentation from Professor C.P. Chandrasekher. I congratulate him for this. It's a very, very learning experience. Coming to the topic that I have been given, what farmers need from banks. I think that the neoliberal trajectory in banking, if there is one section which has been the worst hit by the denationalization and the neoliberal direction of the banking sector, there is no doubt that it is the farmers of India which have been one of the worst hit as a result of the policy changes by the neoliberal policy trajectory. I think all of us are aware that after neoliberalism started, from 1995 to 2020, the National Crime Records Bureau, which is directly under the Union Home Ministry, has come out with figures saying that more than 4 lakh farmers in India have been forced to commit suicide. This is something which is absolutely shocking, absolutely unprecedented in the history of India so far. And this is basically, these farmer suicides are related directly to the debt crisis. It is because they have been drowned in loans which they cannot repay. That is one of the major reasons for this suicide of 4 lakh farmers in India in the last 25 years. One of the major reasons for these suicides is precisely the policies of the banking sector in the neoliberal period have seen to it that much less credit comes to the farmers, much more credit goes to the corporates, to the agri-businesses and other sections under the guise of agricultural debt. And therefore, because the farmers cannot avail of the debt, institutional debt, they are forced to go to the informal sector, which consists of the rapacious money lenders in the country, which charge interest at anything between 5 to 10% per month, which comes to 60 to 120% per year. That is what the farmer has to pay a private money lender because he does not get the loan from the banks. And that is the main reason for the crisis. I will come to that at the end. But before that, let us analyze what exactly has happened vis-a-vis the banking sector and agriculture. There were basically three phases of change and continuity in the sphere of agricultural credit in India after 1991-92, when the liberalization policy started. The first phase was the period between 1991-92 and 2003-2004. This phase of financial liberalization witnessed a reversal of several achievements of bank nationalization. There were, for example, number one, large-scale closure of commercial bank branches in the rural areas. Number two, a sharp fall in the growth of credit flow to agriculture. Number three, a widening of interstate inequalities in credit provision. Number four, increased sidelining of small and marginal farmers in the supply of agricultural credit. And number five, increased exclusion of Dalits and Adivasis from the formal financial system. A consequence of this squeeze of formal credit in the 1990s was the resurgence in different degrees across India of the informal sector of credit, which I talked about right now, particularly the rapacious private money lenders. The expansion of the informal sector of credit sharply raised the costs of credit in agriculture in the 1990s. The second phase began from 2003-04 and continued till 2011-12. In this phase, the downward trend of agricultural credit was reversed and there was some kind of a revival. However, agricultural credit assumed a totally different role in this phase of increasing financing new forms of commercial, export-oriented, and capital-intensive agriculture, including that by corporate houses. There are four features of agricultural credit in this phase. One, a part of the revival in agricultural credit was on account of a dramatic increase in indirect finance as opposed to direct finance to farmers. The definition of agricultural credit itself was diluted to allow banks to provide more indirect finance and include them under the priority sector. Second, even within direct finance, and surely so within indirect finance, there was a rapid growth of large-sized loans that were unlikely to be borrowed by farmers. Most of the large-sized loans were given to large agribusiness enterprises. Third, about 1/4 of the direct finance and more than half of the indirect finance was provided from urban and metropolitan branches of the banks. And the fourth was about half of the agricultural credit in a year was dispersed by the banks in the January to March quarter, when all operations in farming were completed. So these above 4 points show that although the downward trend of agricultural credit was somewhat reversed, this credit basically went to the corporate sector, to the big agri businesses, and not to the farmers to whom it should actually have gone. The third phase began in 2011-12, and we have got the figures, say, up to 2018-19.
You are muted, please.
This is the time of the Modi regime, roughly. And what happened in this phase? Some of the essential features of the second phase continued into the third phase, but the growth of agricultural credit slowed down in this phase as compared to the second phase. Much of the earlier diversion of agricultural credit to corporates and agribusiness firms continued unabated in the third phase. In other words, it is most unlikely that small and marginal farmers were the major beneficiaries of agricultural credit in the third phase also. Results from the AIDIS reports of 1992, 2003 and 2013 reaffirm many of the above conclusions. These surveys provide household level data on indebtedness for two groups, all rural households and cultivator households. All the rural households operating at least 0.002 hectares of land were treated as cultivator households. What happened in this phase? First, a higher share of rural and cultivator households was indebted in 2013 than in 1992. The share of cultivator households indebted rose from 25.9% in 1992 to 35% in 2013, which shows a direct nearly 9% increase in indebtedness of the rural households and the cultivator households. Secondly, the rise in the incidence of indebtedness occurred alongside a rise in the debt asset ratios, which shows the extent to which debt is a drain on the value of owned assets of households. The debt asset ratio for cultivator households rose phenomenally from 1.6 in 1992 to 2.8 in 2013. That means that's a very big jump. Thus, alongside a higher share of indebted households, there was also an intensification of the debt burdens. Thirdly, from where did the higher share of indebted households borrow? This question will naturally arise. For all cultivator households, the share of debt outstanding from the formal sector fell from 66% in 1992 to 58% in 2013. After 2013, it must have fallen much more. The reason was the withdrawal of commercial banks from lending to cultivators. Between 92 and 2013, the share of debt outstanding from commercial banks fell from 35.2% to 27.7% for all cultivator households. Concurrently, informal sources of credit became increasingly more important. If only 30.6% of the debt outstanding of cultivator households was from the informal sector in 1992, the corresponding share rose to 41.6% in 2013. That means that what the cultivators or the farmers took from the private money lenders, that increased by nearly 11% in this period, from 30.6 to 41.6% in 2013. Within the informal sector, it was the share of debt from money lenders that rose the most sharply. For all cultivator households, the share of debt outstanding from money lenders rose from 17.5% in 1992 to 31.5% in 2013. I have already mentioned what is the rate of interest of these private money lenders which they charge. I have said it is anywhere between 5 to 10% per month, which means 60 to 120% per annum. But the farmers have no choice. And that is one of the main reasons for the debt trap and for the farmer suicides on the one hand. And secondly, those who don't commit suicides, lakhs and lakhs of farmers have had to part with their land and join the ranks of landless agricultural laborers. There are many figures to prove this fact also. And therefore, we find, on the one hand, farmer suicides, on the other hand, farmer pauperization, losing of land, landlessness, and them joining the ranks of rural agricultural labor or any other kind of informal labor, going to the cities, becoming a part of the migrant labor force. So these are some of the main trends, if you see the neoliberal era of the last 30 years and a little more. As I said again, these latest figures stop at 2013. If you see from 2013 to currently 2021, data when it becomes available, it will certainly show. Already we have seen during the Modi regime, farmer suicides in the last 7 years have increased by more than 40% over the previous set of years. And that itself shows that the agrarian crisis has deepened much more from 2014 up to now in the last 7 years than what it was in the earlier years. Therefore, a closer and disaggregated analysis using AIBOC data would show that aggregate banking data from the RBI hides a number of disquieting features of distribution of credit. Across 3 decades of financial liberalization, the status of cultivator households appears to be much worse off than before. My friends, I will just add 1 or 2 examples, which is in the nature of field surveys that we conducted in Maharashtra, in the Vidarbha region, and in the Marathwada region, which are the 2 biggest regions of farmer suicides. As most of you are aware, Maharashtra has been leading in the number of farmer suicides in the entire country over this 25-year period. Out of 4 lakhs, the contribution of Maharashtra to farmer suicides is more than 70,000, number one in the country. And out of Maharashtra, the largest number of farmer suicides are from the Vidarbha region, followed closely by the Marathwada region. Both these regions are backward. Both of them are basically cotton growing and other soya bean, etc., these other crops, etc., are there. And there, when we had gone and done field surveys in districts like Wardha, Nagpur, Amravati, Yavatmal, Nanded in the Marathwada region, Hingoli in the Marathwada region, when we had gone to the households where there had been farmer suicides, we found two major points which conform to what I have placed as part of the analysis. But this we actually confirmed when we actually went house to house. Many of our All India Kisan Sabha comrades, we gave them this thing all over the country. We went to various districts, various villages, went to the homes of these people, and we found most of the suicides were because the banks, which had loaned some money to the farmers, they went after them with a vengeance. There was tremendous social anathema which they faced in the villages. They could not really face that because it's a question of social prestige also. And that was the main reason for the suicide of farmers who had actually borrowed from the banks. And the second reason was many of the farmers told us that the banks were refusing to give us loans. And that, as I have mentioned, right from neoliberal times, even earlier, we are not saying that this matter was not there at all. But certainly bank nationalization did have a positive impact as far as the middle and some of the smaller farmers were concerned. Many of them did get loans. We are not claiming that all of them got loans, but definitely there was an ascending trend at the time of the bank nationalization and after. But after neoliberalization, that saw a very sharp decline. And many of the families whom we visited, where there were farmer suicides which had occurred, they clearly told us that the banks refused to give us loans. We had to take the loan from the private money lenders at killing rates of interest. And that is what, there was no chance at all of being able to repay the loan with this tremendous interest rate. And that is the reason why people from that household have committed suicides. So these are certain things that we have actually seen with our own eyes. The All India Kisan Sabha activists moved, and we have seen this. And therefore, one of the major demands of the farmers' movement today, I'm not talking about the current movement which is going on, but the earlier movement that was led by the All India Kisan Sangharsh Coordination Committee, one of the major demands was a complete loan waiver to farmers and agricultural workers. Towards that end, we had placed a private member's bill in Parliament. Comrade K.K. Ragesh, our Rajya Sabha member of Parliament from Kerala, he placed it in the Rajya Sabha. Mr. Raju Shetty, he placed that bill in the Lok Sabha. And the second bill that also we placed, that bill was implementation of the Dr. M.S. Swaminathan Commission. You know, he was the chairman of the National Commission on Farmers. And this very important recommendation that he made was that all the crops of all the farmers, MSP must be declared at 1.5 times the comprehensive cost of production. The formula which we say C2 plus 50%. And that is definitely one of the major demands of the nationwide farmers' struggle, which is going on today. The other demand, of course, all of you are aware, repeal of the 3 anti-farmer and the anti-people farm acts imposed by the Modi government by murdering democracy, by murdering federalism. These are the demands, and also the withdrawal of the electricity amendment bill. So therefore, that I'm not going into. This is just a small diversion regarding this very, very major struggle, which has completed 8 months on the 26th of July, still going strong. But in conclusion, I will only say that the present move by the Modi government to further privatize banks is a colossal mistake. It's a criminal mistake which must be opposed tooth and nail by every patriotic Indian. It's not only the farmers who are going to suffer, it is also the working class that is going to suffer. It is also the middle class that is going to suffer. And it is, of course, the bank employees which are also going to be in the soup as a result of this privatization drive of banks, of the insurance sector, of the entire financial sector. And in fact, it is nothing less than a sellout of the country, the sellout of India, which the Modi and Shah government are going ahead. I think that these webinars must definitely create, and they will create, a total kind of a milieu for raising the struggle against privatization, for preserving our national assets, for preserving our national wealth, and for preserving the idea of India. With these words, I conclude. Thank you very much.
Thank you very much, Comrade Ashok Dhawale, for clearly explaining how in the last 3 decades, in a phased manner, credit has become a rare commodity for the real farmers, especially the small farmers and the marginal farmers, and how by changing the norms in the priority sector, the larger credit is happening in the cities and metropolitan areas, and how the 3 phases differ, though the credit might have increased, but it has not reached the real farmers, but more credit has gone into allied agriculture and other agricultural activities, because of which the real farmer is once again forced to go to the money lenders who are paying such a huge interest rate of 60% to 120% per annum, that it is mainly because the commercial banks have almost stopped giving credit to the real farmers. And you have also given what is the solution. The banks have to lend more to the farmers. The priority sector lending norms have to be once again relooked, and that only the farmers' suicide can come to an end. And you have also spoken about the 3 laws and the Electricity Act. And you have very rightly pointed out that privatization will be a colossal mistake, criminal mistake, and every patriotic Indian have to fight against that. Thank you very much, comrades. Now we will listen to Comrade Deepa, Dr. Deepa, who is representing the Democratic Youth Federation of India, DYFI. She will tell us about the need of the farmers, not farmers, need of the youth and the students in this country from the banking sector. Over to Dr. Deepa.
Thank you, Comrade Franco, and good evening to all. It has been a very privileged moment for me to be part of the speakers along with Comrade Ashok Dhawale and Professor C.P. Chandrasekher. And I also congratulate Franco and his team for continually conducting various lectures and which enlightens various issues, especially with related to banking sector. So here I would like to, my presentation would be focusing on students and youth and what is their expectation on the banks today. So in the Indian context, though we talk about students and youth, we have to look into this category very critically because they are not an independent category. We all know, there is a very serious social economic inequality which still continues in our country, and it just not influence. It's not influencing them in a very individualistic way, but it's very systemic. In terms of access, in terms of accessing their rights, and through many dimensions. So if we are not going to look into these categories with these dimensions, then we'll be losing the reality to understand, the issues of students and youth. So I think it's very important for the banks also to, understand this background while they approach various credits and loans for students and youth. So with it, I would like to go into major issues what students and youth face in this country, especially when we look into students. The major challenge, what the students face is the privatization of education. Though primary education has reached to some extent, I know primary education is still under the government, and we see though there is a question of quality of education in primary education, the main thing what we face is the issues in higher education. When students, want to go into higher education, privatization of education has become a huge challenge. We see that various categories, especially the all India level, we see around 25% of school students reach higher education, which is which represent all social groups. And we look into various social groups, like for example SC, it comes 21%. It lowers down, and then if we go into various dimensions of with related to gender or tribal, I think this percentage is going to go even more less. And when we look into professional education, this is going to be even more less. So reaching for a higher education itself is a challenge for the students of this country. And then with this systemic difference or systemic inequality, this privatization of education has played a huge challenge. So the lack of, there is also many other reasons, like the state government, like both the speakers, Comrade Ashok Dhawale and Professor C.P. Chandrasekher, laid out the background very clearly, especially after, the new liberal policy. The government has totally withdrawn, the money spent on welfare, and especially, on education. And many other welfare. So this education, like this government spending very less, it's continuously lessening its spending. We see that new education institutions, opening of new education institution is becoming very less. So that leads to another challenge and you see there is also, especially in the recent period, we see lots of debates, lack of implementation of reservation in education institutions. And there's a very good example is the IITs of this country, where, in terms of students and in terms of also like employment, we see a reservation is not implemented at all. And the recent, another one which is fiercely debated is the new education policy, which all comes under privatization of the education. The new education policy directly encourages privatization of education. And you see, it's not just privatization of education what they talk about, it's also about, they talk about public-private partnership, which is also an indirect, like privatizing the education system. So what happens, this privatization of education system, like the fees is increased a lot. And then it is not possible for a poor urban youth or for the rural youth or sections or first generational students to actually, cope up with these kinds of fee structures. We also see lessened fellowships and scholarships for various sections of students. And it is also that there are very new professional courses coming up, new courses coming up, which most of the time it's offered by private institutions. So, these kinds of challenges are faced by students, and then how do they cope up with these challenges? And this privatization, this new education policy has come up with entrance for everything. So they're going to even bring up entrance exam for UG levels. Even after finishing their 12th, students have to go through all India level entrance exam to enter into various courses. So even in Tamil Nadu, we have a very major debate on the entrance on NEET, and students organization, various educational activists and social groups are fighting against this entrance exam system, and especially this medical college entrance exam. So what happens to this entrance? Why are we actually, like fighting against this entrance exam? It's not just a system, it gives a very major economic burden to the students. So when you have to kind of study for any entrance exam, there is a very systemic coaching centers which is being emerging, whether it is for NEET or whether it's for any entrance exam, and it has a very high fee. So normal students, low income, middle class students, or students from youth, from rural backgrounds would not be able to pay these kinds of, high entrance exam coaching centers. And even for, this is one dimension. There is like many other things, like even if I finish my UG, or even if I finish my PG, or in fact, even if you finish your PhD, you don't get jobs immediately, or even in very major professional courses, you don't get jobs immediately. So what happens, you have to, now the new trend which is emerging is that you have to study new courses, like 1-year courses, or like very short-term courses, which offers, a job in the job market. So these kinds of courses are emerging up, and students have to start studying for these kinds of courses. So all these major new changes in the education system itself, and privatization, total privatization in higher education, has given a huge economic burden to the students. So where do students rely on? They rely on nationalized banks. We see that most of the loans, like in fact 91% of students' loans, the students go get loans from nationalized banks only. And we also see in the recent period, though there was an increase, like students were going to banks to get loans, there was also, like in the recent period of time, I think the last 4-5 years, there is a dip in students getting, like almost like 25% have reduced students, getting the loans to the nationalized banks. So what we need is mainly is the process made friendly to the students. Though we get loans for, I think, to up to 4 lakhs, you don't need to produce assets, but the processes are made very hard for the students to actually, get the loans. There is a very serious lack of information, among the students, especially among the rural students and urban poor, on what kinds of loans the banks offer. Like, how do I go get the loan? What are the procedures like? Because, especially the challenge comes from the first generation students who doesn't have anybody to give them guidance, or like to support them in these kinds of processes. So it is expected that the nationalized bank should not see it as a loan, as a separate category, but it should be seen as a part of a social cause, and it should be part of a state policy to actually expand or extend the number of amount and the numbers for the students, to avail these kinds of loans. So lack of information is what, like, majorly been said among students, to get loans. So these kinds of emerging challenges has to be incorporated by the nationalized banks, because when we see, in the private banks, there are many private banks which go to colleges, talk about their loans, to talk about what kind of offers they make. Those kinds of aspects have been followed by private banks. I think the nationalized bank has to kind of go to students to offer loans, and that would be a major game changer among students. And when we talk about youth, there is a whole, employment relation has undergone a large change in recent years. So after neoliberalism, and especially after 2000, you see that nobody, think even about a permanent job. Most of the jobs are informal, casual, and then especially for youth, even for an educated basic degree holders, go for contractual work. So these kinds of the job market has totally changed after neoliberal policy has been implemented. And we see that it has been very clear, especially in 2019, the early period of in the early years of 2019, and afterwards, unemployment has become a huge issue. It's not just during pandemic. We saw the signs in 2019 itself. Like we saw that almost the unemployment has gone high in the last 40 years. The unemployment has gone high in 2019 and still continues. And then we also face the pandemic challenges too. What it is not just unemployment, it is also underemployment and loss of employment, what the youth are facing in terms of employment in this country now. So we see that there is development without jobs. Job losses, not just job losses in informal sector, job losses in private organized sectors too. We see that there is a trend among youth to get themselves involved in self-employment. So self-employment is a category where they need capital support. And then what the capital support which I'm talking about is not a huge loans, because we don't, most of them don't go for huge loans. They wanted to have a small, small credit, small loans. Itself would be a challenge for them, like because they cannot mobilize the loans alone. So they need a very small loans to start up small businesses, kinds of things. You see, especially in urban sector, urban poor youth. You see, most of them, where do they work? They work with like executives in various sectors. You see now executives are there. And then you see in self-employed categories, apart from small institutions or small businesses, self-employment categories like drivers, auto drivers, car drivers, and you see lots of youth nowadays are entering into like these small works like Swiggy and kind of. So why I want to mention this is that these kinds of jobs need mobility. They need two-wheelers. Which youth enters into the job, they need two-wheelers. It's a very simple, we may think what is a simple two-wheeler issue, but a youth who doesn't have it would not enter into these kinds of jobs. So they need, when we talk about loans, we talk about starting a business, but there are allied kinds of needs for the students to even for the youth to even get a job. So there should be loans for these categories also. And the loans, like another thing, what especially students and then the youth, once they finish their education, you get into a job. But like what we see is the employment challenge we have. The students and the youth are not able to pay back the loans on time. So the banks have to like kind of be more flexible in this aspect. In Tamil Nadu, we had Democratic Youth Federation of India took up a movement for not only offering loans for the students, it's also about the bank should not be forcefully getting back or asking the students and the youth to pay back the loans. We see in the last 4 years, like there are lots of suicides happening, and there was one case in Trichy which triggered the whole debate, where I think he got the loan. He was engineering student. He got the loan from the nationalized bank. But what happens is, like we see when practically in the ground level, nationalized banks have outsourced, especially to get back the loans. So when the outsourcing happens, and this outsourcing executives, you go and treat the students and the youth very badly, and they pressurize the students and the youth to pay back loan immediately. So that should not happen. With the challenge in unemployment, even the student who finished the course is not able to get a proper employment. Immediately to pay back the loan would be a huge challenge. And in some cases, they don't even get a job for years, and then paying back would actually be a huge challenge. So these kinds of dynamics has to be, thought over by the government and by the nationalized banks to actually, make ways for students to be make ways for the students to get back the loans in a more flexible way. There is another aspect which we see is the credits or loans available for young women. Again, with the lack of permanent jobs and the aspirations of young women, especially in urban centers, to get income, we see there is a large section of women entering to self-employed, especially in the beauty industry, in tailoring kind of small boutiques or tailoring shops, or basic food processing units, or many other self-employed kind of a category which women take it up. Though there are few loans for women to take up loans, it is not enough, and it's not wider. And all these loans, all these categories which I'm talking about, is all small credits which they would want to avail, and the banks have to kind of come forward and make this possible for youth, and that is very important. And one more thing which we need to understand is that most of the banks are becoming digital, and but the reality is that there's a huge digital divide among even among youth. So we see that there is a kind of an understanding that youth are more into digital banking and mobile banking. We still have a challenge among rural youth, especially, like even with a simple mobile banking, especially in rural areas in Tamil Nadu. If we look into this whole delta regions or in the southern districts, we don't see access, the digital access is not more. So the more the bank goes into digital access, it's going to actually not help rural youth to actually come forward, to access banks and access basic banks and processes, and also on credit loans also. There is another huge challenge what we face is about the shrinking of nationalized banks itself. So when unemployment, underemployment, when job losses are happening, there is only through government jobs still, the social justice can be ensured. Especially reservation can be implemented in nationalized banks only. Though we have lots of private banks, you don't have reservation-based employment intake. But the shrinking of nationalized bank itself is a huge challenge for educated youth to get into these kinds of permanent kind of jobs. And first-time educators, like marginalized sections of youth. So you see this very lessening number of kinds of jobs, which is going to be a huge challenge in terms of social justice too. So the main thing what we need to kind of look forward is that the state also has to, like, I think, view nationalized bank as not just in this aspects, like especially in the social development. The state has to take up nationalized bank as part of social development itself. So the nationalized bank has to come up with new policies. There is a problem, yes, the speakers have already said how the nationalized system is been shrinking, but within the existing system itself, there is a need to be more openness, to be more accommodative to students and youth, because they form the basis for the future of this nation. So with this, I conclude my speech.
Thank you, Dr. Deepa. That is amazing. Your presentation has really highlighted what are the issues for the younger generation, especially the students and the youth, and you also touched upon on the women. Your demand that there should be a review of policies, a new policy for nationalized banks is needed is very much correct. The mainstream bankers are not worried or they are not even aware of what is happening to the larger majority in this country. You rightly pointed out that there are new courses introduced by the new colleges, the private colleges, the so-called deemed universities and all, where the fees is so high, and unless you undergo that course, you are not employed. There are various statistics. They say that children who are coming out of the engineering colleges are not employable. And you rightly pointed out that you have to undergo another short-term course for 6 months or 1 year. And that course demands huge fees to be paid. And for that, no education loan is available. So unless you have access to credit, employment becomes very difficult. And you also pointed out that with shrinking of number of branches and the nationalized banks getting merged, which I could understand that the jobs are going down in the field. The job opportunities in the public sector banks are also going down. That is also affecting the social goals. The reservation policy goes with when you are going to a private bank, there is no national reservation policy. So if banks are privatized, the reservation policy will also go. And that you also rightly pointed out that when you are looking at credit, the banks are not looking at small credit. I know that the banks have tie-ups for car loans. They tie up with an agency, car dealer, and for buying of car, if a rich fellow goes to the car dealer, immediately he tells him that, okay, this bank is willing to give you loan. With up to 90% you can get it at loan, and that dealer also gets some commission from the bank. But in the case of two-wheeler, that is where the need is more. The young generation needs more of that for various activities. We are also seeing that number of our younger generation is with the Danso and Swiggy and Zomato. So for them, the vehicle, two-wheeler is needed. For that, we practically know that every two-wheeler dealer has a tie-up arrangement with a non-banking financial company, Bajaj Finance or similar organizations, where the credit, they say that it is zero interest and all, but there is a hidden cost and you are paying a huge cost. These are aspects of banking industry, the mainstream public sector banks have not looked at. And you also pointed out that case of Madurai, where an education loan from State Bank of India was sold to Reliance Asset Reconstruction Company, and those fellows threatened that person, and finally that person took his life itself. So this kind of injustice is happening even within the public sector banks. By the outsourcing, these are to be corrected. And you also pointed out that women need credit, especially younger generation women. See, there are schemes available, but these schemes are not reaching everybody and it is not adequate. That also, as a banker, I would like to share to the participants that, say, Startup India scheme, you can get a loan from 10 lakhs to 1 crore. It is available for the SC, ST and women entrepreneurs. But there you are saying that they have to be a first generation entrepreneur. They should not, their family should not be into this business. And ultimately, what practically banks are doing is that instead of giving loan in the name of women, the husband gets the loan, who is already having access to credit and who is already doing a business well. So the real entrepreneur does not get the startup loan scheme. So that practically we are seeing. Even in the case of the Mudra loans, we are seeing that the access to credit is not adequate. A person comes for a loan, he might require 2 lakhs, but the bank will give a loan under the 50,000 scheme so that they can reach the target in number. So that fellow for 2 lakhs, if he is getting to get only 50,000, another 150 he borrows from the outside and then he gets indebted. Either he fails in the business or he is not able to repay the loan. So it is a vicious circle which is undergoing. So that is why we require a total overhauling of the banking policy as a whole. That is, has been the purpose of this webinar, and we have learned quite a lot from each speaker. And what I propose from the People First as well as from the Center for Financial Accountability is that we will make a document of all the webinars. It is available in Facebook and YouTube also. The videos are available on a regular basis. But we will bring out a report and we will also suggest what is to be really done for the banking system. The Nirmala Sitharaman, whatever she talks and what is happening in the field is not adequate. And one more thing I would like to add here is that when I was in Israel for studying the agriculture system and the credit system in Israel, for the startups, it was revealing to me that they don't require a loan. The government itself provides, if somebody comes with a viable idea, the bank, they don't have to go to the bank. The government gives them the initial seed funding. With that, they start the enterprise. And if they are succeeding, then they again get the first tranche of loan from the government itself at concessional rate of interest. And when they succeed, automatically what happens is that the people, the bankers, they go to them in search of them and tell them, okay, now you expand the business, we will give you a loan. Whereas here, for a small entrepreneur to go and get a loan, it is not available, and that is being forced on the banking system, and banking system finds it difficult to deal with it because the demand is so high, but the amount available for the small credit has shrunk over a period of time because of the change in policies. So with this, as there are no other questions, I think we can conclude, and I will request Ashish from CFA to propose vote of thanks. Ashish, you are there now? Yeah. Ashish, you are there? Can you hear me? Or I request Mohini, the interpreter, to propose vote of thanks.
Hi. Yes, thank you, Comrade Franco. Can you hear me?
Yes. Yes, we can hear you.
Okay. On behalf of People First and CFA, I thank our prominent speakers for today, Professor C.P. Chandrasekher, to covering the banking history and how we have reached today and the role of neoliberal policies to reach the point in banking where we are at the juncture of privatization. And Comrade Ashok Dhawale for taking us very thoroughly with the problems of agriculture and the small farmers as they are facing, and in the last few decades how dilution of priority sector lending has also created problems for them, and Comrade Deepa for taking us through all the problems and the expectations of the youth and the students, especially for students and their higher education. I also want to thank all the participants for taking part in this webinar series. This is the last webinar in this Nationalization Week webinar series. And we have had very prominent speakers throughout the webinar series. Though today we have a less number of participants, but we will be sharing the recording for all the previous webinars and today's webinar with all of you. I also want to thank you, Amit and Mohini and Maya Dasanji for their.
मैं सभी अनुवादकों का भी धन्यवाद देना चाहूंगा कि उन्होंने
1 second. I think there is some issue with the interpretation channel. Mohini, can you please? Okay, thank you. For helping us with the Hindi and Tamil translation, and Kavita for making all the posters and taking care of social media and everything. And in the end, Comrade Thomas Franco for starting and having the idea of doing this webinar series. And we started on the day of bank nationalization. Thank you, Comrade Franco, and all the other speakers who were here in this webinar series throughout as speakers and as participants. So thank you, everyone. We will be sharing the recordings of this series with all of you in WhatsApp or through emails. Thank you, everyone.
Thanks to Mr. T.R. Bhatt and also Comrade Sridhar from Frontline, who had and many other friends who are in this session who have joined. Comrade C.P. Krishnan is there. Comrade Nandakumar had been there. So thanks to all the participants, and very soon we will have another session, not on nationalization, but how to prevent privatization of IOB and Central Bank of India. That I am planning. We will share with you the details very soon. So with this, we conclude this webinar series, and I thank CFA, Comrade Ashish, Priya, our Kavita, and Mohini, all others who had been giving so much of support to see that this webinar became a great success. Thank you one and all. With this, we conclude. Good night.